All right, today we're tackling a real head-scratcher in the auto world. It's all about CIE Automotive India, a giant in its space that just released some numbers that, well, they just don't seem to add up. It's what I'm calling the profit paradox.
And this right here is the big question, the mystery at the heart of it all. Think about it. CIE Automotive just had its best sales quarter ever. That should be champagne-popping news, right? But at the very same time, its profits actually went down. How does that even happen? And here it is, laid out in black and white. It's really a tale of two completely different stories. On the left, you see that record-breaking revenue, which is fantastic. But then you look to the right, and profit is down by 4.5%. More money is coming in the door, but less of it is actually sticking around. That is the puzzle we're going to solve today.
So first up, record revenue, shrinking profit. We're going to dive right in and unpack this puzzle. We've seen what happened, but now it's time to figure out the why. Okay, moving on. We're going to take a look under the hood. It's time to follow the money trail and see if we can find out exactly where those profits vanished. So, as they say, the numbers don't lie. And this table gives us our first major clue. Now, net sales did go up a little bit, which is good. But the real story is down there at the bottom, that operating margin. It fell from almost 15% to just under 14%. A 1% drop might not sound like much, but trust me, in this business, that is a really big deal. And this chart here just makes that drop crystal clear. You can literally see the profitability getting squeezed from one quarter to the next. This is what the experts call margin compression, and it is pretty much the smoking gun in our investigation. So what exactly is it? Well, let's break it down. Think of operating margin as a company's efficiency score. It tells you how much profit they're making from their main day-to-day business, before things like interest and taxes. So when that margin falls, it means for every single rupee they make in sales, they are pocketing less and less as profit. It's like the engine is revving higher, but the car is actually going slower. So where did all that money go? Well, we found the culprits. There are three big ones eating away at those record sales. First off, employee costs shot up by almost 10%, way faster than sales grew. Then you've got interest costs. They more than doubled. And maybe the most alarming of all, the actual cash they're generating, that plummeted by over 36%. Plain and simple, they're spending more and getting less cash in return.
Okay, so that's the internal picture. But is this an industry-wide problem, or is Enmore CEI just falling behind the pack? Let's put them side by side with their competitors and see how they really stack up.
And wow, this one really tells a story. Over the last year, the auto components sector as a whole was on fire, up almost 33%, and CIE just a little over 6%. That is a huge gap. It's pretty clear this isn't just about the market. This looks like a CIE-specific problem. Okay, let's get a bit more granular and compare them to some key peers. We're going to look at two big metrics here: return on equity, or ROE, which is all about profitability, and the PE ratio, which tells you how the market values the stock. And you really don't have to be a Wall Street analyst to see that CII is lagging, especially on that ROE number. They're just not making as much money as the competition.
This chart right here just puts a massive spotlight on that profitability gap. I mean, just look at this. For every dollar of shareholder money that's invested, CIE is making about 11 cents in profit. A top player like Motherson Wiring, they're making almost 40 cents. That's nearly 4 times more efficient. It is no wonder investors aren't as excited about them.
All right, so we've seen the good, the bad, and the kind of ugly. Now it's time to put it all on the scales. Let's weigh the strengths against the weaknesses, the full bull versus bear case. And here it is, the whole debate in one place. On the one hand, the bulls, the optimists, will tell you it looks like a bargain. The stock is cheap, the company has cash, and they pay a decent dividend. But on the other hand, the bears, the pessimists, have a lot of ammunition. They'll point right back to those shrinking margins, that weak ROE we talked about, and the fact that the company is getting left in the dust by its sector. It's a real tug of war. Which brings us to the million-dollar question, right? The ultimate question for any investor looking at this. Is CIE Automotive a true value stock, a hidden diamond in the rough? Or is it a classic value trap, a stock that looks cheap, but is cheap for a very good and potentially very painful reason? This quote from the original Markets Mojo analysis just nails it. It's a complex investment proposition. In plain English, the cheap price makes you look twice, but the crummy performance makes you nervous.
It's that classic battle, valuation versus quality.
So, where does that leave us? What's the verdict? Well, based on all of this, the final call from the analysis is a hold. It's not a screaming buy because, well, the performance just isn't there. But it's not an urgent sell either because it is cheap. The company is basically stuck in investment limbo.
And that hold verdict is pretty much summed up by its overall mojo score, 65 out of 100. I mean, it's a passing grade, but you wouldn't be bragging about it on the ride home. It just screams good but not great. The score tells us that, yeah, there are some strengths here, but those red flags are just too big to ignore for now.
And that leaves us right back where we started, with a big question. Is this an opportunity for a really patient investor who's willing to wait for a turnaround? Or is it that classic value trap we've been talking about? It really all comes down to your personal investment philosophy. Do you take a chance on a cheap stock, hoping it'll fix its problems? Or do you wait on the sidelines for proof that the engine is actually running smoothly again? The price is tempting, for sure, but without a real operational comeback, it could be a long, bumpy
all right,
ride.
let's just get right into the thick of it today. You know, usually when people talk about market psychology, it sounds kind of abstract.
Right, like you're guessing.
Exactly. Like we're trying to guess what millions of strangers are feeling on any given day. But then, you pull up a chart like the one we have today, CI India on the NSE, and suddenly that psychology isn't abstract at all. It is literally painted right there on the screen in red and green.
It really is. It's basically behavioral economic and high definition. I mean, you can see the fear, the apathy, the greed, and especially if you're looking at today's specific candle, the sudden reality check.
Yeah, that is actually the perfect outline for this deep dive. So for everyone listening, we are looking at the daily candlestick chart for CI India. And the time frame we're capturing here is from roughly mid-August last year, so August 13th, 2025, right up through today's close, Friday, February 20th, 2026.
A very eventful 6 months.
Very. And the reason I wanted to pull this specific chart for us to look at isn't just because of the massive rally we've seen this month in February. It's really because of their narrative arc. It is rare to see a chart that follows the textbook structure of a market turnaround so perfectly.
Oh, absolutely. It's a masterclass in market phases. We are seeing a clear distribution phase, a really brutal markdown, a classic accumulation period, and now the markup. If you're a technician, this is the kind of chart you just want to frame and put on your wall.
Our mission today is to essentially dissect the anatomy of this breakout. We aren't here to give financial advice, obviously, but we are here to read the story that the data is telling us right now. And to set the scene for you, we're looking at a standard daily candlestick chart. We've got Bollinger Bands overlaid on the price action, an RSI indicator in the middle panel, and volume bars at the very bottom.
The holy trinity of technical analysis.
Exactly. So let's start at the finish line just to set the stakes for what we're talking about. I'm looking at the data for today, February 20th, and this was not a quiet Friday.
Not even close. The volatility came roaring right back.
We opened at 465 even, which was already showing some solid strength. But the intraday swing is what really caught my eye here. We hit a low of roughly 452.55 and a high of nearly 480, actually, 479.80 to be exact. That is a massive range for a single session.
It is. It represents a total battle for control. When you see a stock swing almost 30 points in a day after a sustained rally, it tells you the easy conversation is over. The bulls and the bears are actually shouting at each other now.
And we settled right in the middle at 469.35. We'll get to what that closing price implies later, especially regarding that long wick at the top of today's candle. But to understand why 479 was such a hard ceiling today, we really have to rewind and understand the winter blues.
Yeah, you have to look left on the chart.
Right. Take me back to October 2025. Because looking at this section, this chart looks, well, it looks depressing.
Depressing is definitely the right word for the sentiment, but orderly is the right word for the technicals. Look at the structure starting in mid-October. We had that peak up around the 430 level, and then the floor just completely gave way.
It wasn't a crash, though, was it? Like, it wasn't one giant red candle that wiped everyone out in a single afternoon.
No, and honestly, that's almost worse. It was a grind, just a slow, painful bleed. If you look at the daily candles through November and December, you see a classic, undeniable series of lower highs and lower lows.
Yeah.
Every single time the buyers tried to step in, say, in early November when it tried to pop back up to 420, the sellers were just waiting there with fresh supply. They slammed it right back down.
That is the absolute psychological torture of a downtrend.
Yeah.
You keep thinking, okay, this is the bottom. It's cheap now. I'm buying a deal. And then 3 days later, you're underwater again.
Precisely. And look down at the volume profile during that initial drop back in mid-October. Do you see that massive red bar at the bottom?
Oh yeah, it sticks out like a sore thumb compared to the rest of the autumn volume.
That was the catalyst. That was a high-volume liquidation event. We don't even need to look up the news headlines from that week to know that something shifted fundamentally there. Big money exited. And when big money leaves the stock, it leaves a vacuum behind. The price drifted down for 2 solid months because there was simply no bid to support it.
And it finally bottomed out in mid-December, right?
Mm-hmm.
I'm seeing the price dip below that 394.25 line on the vertical axis.
That right there was the moment of maximum pessimism. When you break a major psychological round number like 400, retail investors usually throw in the towel. They look at their portfolio, they see a sea of red, and they just sell to stop the pain.
But that's usually where the smart money starts poking around, isn't it?
It is, and that brings us to what is probably the most boring, yet mathematically the most important part of this entire chart, which is January 2026.
God, it is boring. I'm looking at this consolidation phase right now. For essentially 4 full weeks, the stock went absolutely nowhere. It just chopped sideways between roughly 394 and 427.
In the industry, we call this a time correction. Sometimes a stock corrects by dropping in price, which is what we saw all winter, and sometimes it corrects by just killing time. It's digesting the previous move. But look closer at the actual daily candles in January. Do you notice a change in character compared to December?
Let me look. They look, I don't know, smaller, less angry.
Exactly that. The volatility completely dried up, the aggressive selling pressure was gone, but there was no aggressive buying to replace it yet either. It was just a stalemate, a long staring contest. And for you listening, this is a crucial concept. This boring phase is where the base is built. Without this solid foundation in January, you simply do not get the skyscraper we saw in February.
Which brings us perfectly to the overlays. This is where the Bollinger Bands get really interesting to me. I love watching these things because they act like a visual pressure gauge for the stock.
They are arguably the best visualization of volatility we have.
So just to paint the picture, we have these 3 lines snaking around the price candles. There's a green upper line, a green lower line, and a red line right in the middle. And in January, as the price is going sideways, those green bands, the upper and lower limits, are pinching closer and closer together. By late January, they're incredibly tight.
We call that the squeeze, and it's one of the most reliable technical setups you can find. Think of the market like a spring or a coiled rubber band. When price action gets compressed into a really tight, narrow range, energy is building up. The market cannot stay quiet forever. It's effectively holding its breath.
So when you see a squeeze like that, where the upper band and lower band are practically hugging the daily candles, you know a major move is coming. But you don't necessarily know which way, do you?
No, you don't. The squeeze only forecasts expansion. It tells you to get ready because something is about to break. It could break down and continue that winter crash, or it could break up.
That's exactly why you don't trade inside the squeeze. You wait for the resolution.
And boy, did we get a resolution in February. We certainly did. The very first week of February, the price didn't just nudge above the upper band. It kicked the front door completely down.
This is the pop. The band's blasted wide open. It looks like an alligator opening its mouth. And the daily candles turned huge and bright green.
And look at the position of those green candles relative to the bands themselves. This is a phenomenon we call walk in the band.
Meaning the price is literally staying glued to that top green line as it goes up.
Or even pushing entirely above it. Statistically speaking, about 95% of price action is supposed to happen inside the Bollinger Bands. So when you see the price closing outside or right on the upper band for consecutive days, it's a massive statistical outlier.
It's defying the math.
Exactly. It signals extreme momentum. It means the buying demand is so strong, it's warping the expected statistical probability of the asset.
It's surfing the wave. But usually when I see a stock defy gravity like this, my immediate instinct is to think it's a bubble, like it's gone up way too fast, it has to crash back down.
Yeah.
But looking at the momentum indicators on the chart, this move wasn't exactly a surprise, was it?
Not if you were looking into the hood. This is exactly why we can't just look at price alone. We have to look at the RSI, the relative strength index.
Okay, let's dissect the RSI, because I think a lot of people just use it as a simple overbought or oversold toggle switch.
Which is a very dangerous simplification.
Right. So looking at the middle panel here, we have the RSI set to 14 periods. It's that white line. And looking at the history back in the winter blues, the RSI was basically in the gutter. It was hovering way down in the bottom half of its range.
Yeah.
Which makes total sense. It was a downtrend, so it had weak momentum.
Correct. But the magic really happened in January. Remember that boring, flat price action we talked about?
The 4-week staring contest.
Right. While the price was completely flat, look at what the white RSI line was doing.
It was creeping up slowly, but it was making higher lows.
That is a classic bullish divergence. It is one of the single most powerful signals in technical analysis. The outward price was saying, I'm weak, I'm going nowhere. But the internal momentum was saying, I'm getting stronger every day. The selling pressure was exhausting itself, and buyers were actually stepping in more aggressively on the micro dips, even if the headline price wasn't showing it yet.
It's like hearing a car engine revving up while the car is still sitting at a red stoplight.
That's a perfect analogy.
Yeah.
The RSI divergence was the engine revving. The price breakout in February was the driver finally dropping the clutch.
But now, looking at today, February 20th, that engine is running pretty hot. The RSI is currently peaking very high, right near that top dotted line, the 70 mark.
We are officially in overbought territory. Now, I do want to be nuanced here. In a very strong trending market, an asset can stay overbought for a long time. It does not mean you should sell immediately, but it does mean the rubber band is fully stretched.
So the easy, safe money has already been made.
I would argue yes. When your RSI hits 70, while the price is simultaneously riding the upper Bollinger Band, you are entering a high-risk, high-reward zone. You aren't buying fundamental value anymore. You're buying pure momentum. You're essentially hoping the greater fool is going to come along and buy it from you at an even higher price next week.
Let's talk about the fuel for this entire move. Because you can have price action and you can have RSI momentum. But if you don't have volume, it's all just smoke and mirrors.
Volume is the polygraph test of the stock market. You can easily fake a price move on low liquidity, but you cannot fake real volume.
So looking at the bottom panel, the volume bars, we already talked about that massive red spike back in mid-October that kicked off the sell-off. But there's another spike that really catches my eye here. It's right in late December, right around the holidays. It's a pretty significant green volume bar.
That right there is what we call stopping volume. Notice how it happened right at the absolute bottom of the chart's price curve. That spike represents a massive transfer of ownership. The last of the panicked, exhausted retail investors sold their shares, and institutional money, the smart money, stepped in to absorb all that supply. They essentially put a concrete floor under the market.
So that green spike was the big players loading up. That's accumulation.
Exactly. They were buying when everyone else was completely terrified. And that volume is what set the stage for the quiet January.
And what about the volume we're seeing in this current February rally? Is it supporting the massive price increase?
It looks very healthy. We aren't seeing diminishing volume yet. As the price is rising, we are seeing consistent, solid participation on those green bars. That tells me this isn't just a quick short squeeze or a low liquidity fluke. There is real, substantial capital flowing into CIE India right now.
Okay, so let's synthesize all of this. We have the perfect setup. We had the brutal winter sell-off, the heavy accumulation spike in December, the suffocating squeeze in January, and now the massive breakout in February, which is supported by strong volume. It all sounds incredibly bullish, like mortgage the house and buy this stock forever bullish.
The structural long-term trend is undeniably bullish now, but
And here comes the but. I knew it.
we have to deal with the elephant in the room, or rather the wick in the room. We need to look closely at today's specific daily candle.
Let's zoom in on that. Today, February 20th, we hit a high of 479.80. We got within touching distance of 480. And then the price just got totally slapped down.
It was a very sharp intraday rejection. A 10-point drop from the daily highs is not insignificant.
So visually, on the chart, we have a green candle with a solid body at the bottom, but this really long, thin line sticking out of the top.
That upper shadow, or the wick, is the literal footprint of failure. It marks the exact spot on the chart where the bulls ran completely out of ammo. They pushed the front line all the way to 480, and the sellers, who are probably the same smart money people who bought back in the December accumulation zone, said, "Thank you very much. I will take my 20% profit right now."
And when enough big players take profit at the exact same time, the price retreats.
Exactly. And when you combine that long rejection wick with the fact that the RSI is hitting the overbought ceiling of 70, that is a flashing yellow light for any trader.
It feels like a warning shot across the bow.
It is. It suggests that the market is getting exhausted. It's gasping for air up here. The buyers simply need a break.
So if you're a retail trader holding C in India right now, watching this close today at 469.35, what is going through your head this weekend? Are you panicking?
I definitely wouldn't say panic. Panic is for when the structural trend breaks, and the trend here is still very clearly up. But I would be extremely defensive. That wick tells me that 480 is a solid brick wall for the immediate future. I would not be surprised at all to see the price pull back next week, maybe go down and test that initial breakout level around 440 or 450.
Sort of a return to the mean.
Right. Remember the middle line and the Bollinger Bands we talked about earlier? That red line?
Yeah, it's way down there right now.
In a healthy, sustainable uptrend, the price often pulls back to touch that middle red line, which is the 20-day moving average, before it continues moving up. Right now, the price is so far above that moving average, it's like a stretched elastic band. Simple physics suggests it needs to snap back a bit to recharge its energy.
That makes total sense. It's physically impossible to sprint an entire marathon. You have to jog for a bit to catch your breath.
And that's exactly what we might be seeing starting next week. The intraday volatility we saw today, that wild swing from 452 up to nearly 480 and back down, is very often characteristic of a market top, at least a temporary, short-term one. Stability creates trends, but high volatility very often ends them.
It's just fascinating how all these technical layers stack up on top of each other. If you just logged into your brokerage app and looked at the percentage gain for February, you'd say, wow, this is an unstoppable stock. But when you look at the daily wick, the RSI hitting 70, and the extreme band extension, the story gets so much more nuanced.
That is the exact difference between gambling and trading. The gambler just sees the green line going up and blindly bets on more up. The trader sees the band extension, the previous momentum divergence, and the volume profile, and they actually calculate the mathematical probability of a pullback.
I want to circle back to the squeeze concept for a second before we finish, because I really feel like that's the big actionable takeaway for you listening who might be scanning your own charts tonight.
It really is the single most valuable pattern to train your eyes to recognize.
We saw it in January. Incredibly low volatility, super tight bands. How often does that actually lead to a massive explosive move like the one we saw in February?
It doesn't happen every single time, obviously, but it happens often enough that it is highly worth hunting for. The market breathes. Inhale, exhale. Contraction, expansion. Most amateur traders get totally bored during the contraction phase. They want action every day. But the professionals absolutely love the contraction because the risk is so clearly defined. Back in January, you could have bought the stock at 400 with a strict stop loss at 390. Your financial risk was tiny.
But buying right now?
Buying right now, today, at 470 with those Bollinger Bands blown wide open, your risk is massive. Where do you realistically put your stop loss? 450. 420. You are literally chasing the bus down the street long after it's left the station.
So the real lesson here is learn to fall in love with the boredom.
Fall in love with the compression. That is where all the potential energy is secretly stored. The big explosion in February is just the kinetic energy finally being released. If you wait for the explosion to make your move, you are always just reacting. If you spot the compression early, you're anticipating.
I love that phrasing. Anticipating, not reacting.
That's the whole game.
Well, before we wrap this up, I want to leave you with a final, slightly provocative thought. We've been fairly cautious about today's wick on the chart. We're calling it a rejection. We're pointing at the overbought RSI and telling people to be careful.
As we mathematically should be.
Sure, but let's just play devil's advocate for a minute. Based on everything we've seen, is there a world where this wick is just a minor blip? I mean, looking at the sheer volume of this turnaround, looking at the raw force of the February breakout, is it possible that instead of pulling back to that red center line, this is actually the start of a massive new super trend?
It is entirely possible. There is a specific market scenario where the price effectively just climbs the ladder. It ignores the overbought signals. It ignores the ugly wicks. It just grinds higher and higher because the underlying fundamental demand is so overwhelming that technical gravity just temporarily stops working. We see this happen in hypergrowth stocks or during massive sector mania phases.
So that 480 mark might not actually be a brick wall. It might just be a small speed bump.
It absolutely could be. If next week we see the price hold completely steady above today's open of 465, if it just stubbornly refuses to drop despite this really ugly rejection candle, that would be an incredible show of hidden strength. That would tell me that the institutional buyers are so aggressive, they are just willingly absorbing all the retail profit-taking without even flinching.
That would be the pure greed phase taking over completely.
Exactly. And that is when things get truly irrational and highly profitable if you can actually stomach the wild intraday swings.
So for everyone listening and looking at this chart with us, Watch that 465 level next week. Watch that 480 ceiling. And for heaven's sakes, watch the volume bars.
Yes, if the volume completely disappears on the pullback, you're probably safe. If the red volume spikes on the way down, run.
Simple as that. Look, we have covered a lot of ground today, from the depressing depths of the winter lows through the boring base building to the dizzying heights of today's close. This daily chart of CIE really does have a bit of everything. It's a fantastic reminder that the price on your screen isn't just a random number. It's a living narrative.
And the main narrative right now is definitely hesitation at the highs.
We will certainly be watching closely to see exactly how the next chapter is written next week. Thanks for taking the time to decode this one with us.
Always a pleasure to dig into the data.
And to everyone out there listening, keep hunting for those tight squeezes on your screens. Don't chase the giant green candles. Look for the coiled springs. We'll catch you on the next deep dive.